In this video, we're going to be talking about the price to earnings ratio, also known as the PE ratio. Now, the PE ratio is a very popular method of valuation, and that's because it is very simple to implement. It's just a one-step process, one calculation. Unlike the DCF, which I talk about in this video over here, do check it out. So what is the PE ratio? What is the price to earnings ratio? So I'm going to use an example to illustrate how it works. And at the end of the video, I'm going to be talking about one of the biggest and yet very common misconception about how the PE ratio should be used. Alright, so let's say we want to compare two companies within the same sector. For simplicity, let's just use Walmart and Target. As of this time that I'm making this video, the price of Walmart is around $136 per share, and the price of Target is around $225 per share. Now let's assume that we are bullish in this sector, but we only want to invest in one of these two companies. Which one are we going to invest in? How are we going to compare them fairly? Alright, before we continue, I just need to mention that the use of these two companies, Walmart and Target, is just as examples to illustrate how the PE ratio is calculated and used. The contents of this video is not meant to be taken as investment advice. One of the ways we can compare the value of these two companies is by using the PE ratio. The formula is pretty straightforward. The calculation is simply the price per share divided by the earnings per share. So let's take a look at the PE ratio for our two companies. For Walmart, we have already established that the share price is $136. The earnings per share, which is a number that we can obtain from Morningstar, is about $2.86. Therefore, we're looking at a price to earnings ratio of around 47.5. For Target, the share price is $225. From Morningstar, we can get the earnings per share, which is around $13.60. Therefore, the PE ratio of Target is around 16.5. So how do we make sense of this? Well, simply put, what it means is that if we buy the shares of Walmart, for every $1 of Walmart's earnings, we are paying $47.50. If we buy the shares of Target, for every $1 of Target's earnings, we are paying $16.50. So based on a PE ratio comparison of these two companies, Walmart is 3 times the price of Target. Wait, so does that mean that Target is a much cheaper stock to buy than Walmart? That, if we buy Target, it's a much better value for our money? Should we be buying Target instead of Walmart? Well, not so fast. Here lies one of the biggest misconceptions about how PE ratios should be used. On the surface, based on the PE ratio comparison, it does look like Target shares are cheaper than Walmart shares. In fact, many articles, many videos, many investment courses out there, they will probably tell you that Target, based on PE ratio, is a cheaper, more value for money investment than Walmart. I guess to some extent there's some truth in that. But the thing is that cheap and expensive are totally subjective terms. Let me give you an example. Sashimi. Now if you go to a fancy, upscale Japanese restaurant, you order, a plate of salmon sashimi, it maybe will cost you around $100. You could also go to your local grocery store, and some of them sell these like little boxes of sushi and sashimi. You could perhaps get the same amount of salmon sashimi for $10. Now both of these options are salmon sashimi. What's the difference between the two? Why are they priced so differently? Now let's take a closer look. Now what if I told you that the $100 sashimi is made from salmon that was flown in from Hokkaido this morning and is prepared by the best sashimi sensei in town, and you're going to be eating it in this really nice, really fancy restaurant with AC, with really ambient lighting and really nice music and the best service that you can get in town. Whereas the $10 grocery store sashimi, there's nowhere for you to sit. Once you buy it, you're gonna have to eat it outside, right by the road. You don't know how fresh the sashimi is. It was probably imported frozen like 5 days ago. I have a very, very sensitive digestive system, TMI, but if I ate something like this, I'm quite likely going to have some problems later. So now when we factor in these things, which one is cheap and which one is expensive? It's relative, right? Why would there be an option for $100 sashimi? Why would anybody want to pay $100 for sashimi when everybody can get it for $10? Well, that's because the quality of the sashimi matters. The quality of the dining experience, the customer experience when enjoying that sashimi matters. And that's why cheap and expensive becomes relative. So if we go back to our two companies, Walmart, Target, they are in the same sector, the same line of business. There is a reason why the market is willing to pay 3 times more for Walmart earnings compared to what it's willing to pay for Target's earnings. It could be because the market believes that Walmart's earnings maybe are of higher quality and perhaps has more potential to grow exponentially in the future. And Target has a lower PE ratio. It could be because the market thinks the quality of its earnings or its growth potential are not as good compared to Walmart. So what we're seeing here is perhaps it's too simplistic to compare the PE ratios of two companies and make a decision on which one to buy based on which company has a lower PE ratio. Perhaps we should also be asking why. Why is there a difference in the two PE ratios? And to answer that, we need to do a deeper research into the company. We need to find out, are these earnings good quality earnings? Are these earnings going to continue to grow in the future? We'll be talking more about the processes of studying the markets and individual stocks as we go along. So make sure you're subscribed so you don't miss out on that. Alright, so that's it for today's video. I hope you learned something new today about PE ratios. Like, comment, subscribe if you found it to be helpful, and I will see you in the next video.